In this video, I'm going to run through some of the top index funds that you can buy right now. I'll show you options that let you invest all over the world, including funds that invest in popular indexes and also some more niche funds that you may not have considered. On top of this, I'll show you some of the best ways to find ETFs and what to look out for when choosing these investments. Right, let's get into it, starting from the top with global index funds. And as the name suggests, these allow you to invest in companies all over the world. And these indexes are essentially going to rank all the companies in the world by market cap. And what that means is that the companies with the biggest values are going to have the highest weightings in the fund. Investing into a global index fund is the true definition of being a passive investor. You're not picking a particular regional sector that you think might outperform. You're not taking a particular view. You're simply just betting on the world, and the index itself will take care of companies changing in value. So if that sounds like something you're after, I've got two options for you, and they both track the FTSE All-World Index. That's an index that covers over 4,600 companies, and it's going to give you that global exposure that you need. The first option is from Invesco with the ticker symbol FWRG. This is a slightly newer fund, but a very respectable broker, and it has an ongoing charge of 0.15%. The second option is from Vanguard with the ticker symbol VWRP. This fund has been around longer than the Invesco fund, and it's also larger in size. Vanguard is probably one of the most famous ETF providers, but you'd also do pay a cost for that with an ongoing charge of 0.22%. Just a note on those costs though, and this is something that probably doesn't get discussed that often, and that's the spread of these funds. That's the difference between the buy and the sell price, and that can change throughout the day depending on various factors, namely the liquidity and the demand of the fund. But when we compare these two funds, the Invesco fund tends to have a slightly higher spread than the Vanguard fund, and that's most likely down to the Invesco fund being smaller in size, which generally means the liquidity will be slightly less. That shouldn't put you off investing, but it's just something to take into account when you're simply just comparing the fee of 0.15 and 0.22. One thing to note with all the ETFs that I've chosen today is that I've used the accumulation share class just to keep it simple and consistent. But of course, if you did want the income paying out, then you'd simply just select income or distributing when you see that option. All accumulation means is that the dividends are reinvested back into the fund. One thing that you'll also notice with a global index fund when you look at the weighting by country is that the US dominates the share with 63% of the market share for most indexes. So while you will get exposure to other countries all around the world, you still have to bear in mind that you still have a high percentage of your portfolio weighted towards the US. Now, if you wanted full exposure to the US market, then this next one is going to be for you, and arguably the most popular index fund out there, the S&P 500. And for this one, I've got two options again for you, one from Vanguard and one from State Street. The one from Vanguard is the one that everyone talks about. It has a ticker symbol of VUAG. It has the reputation and the size, and is one of the most popular investing options out there for people. It has an ongoing charge of 0.07%. When we compare that to the global index funds, these are very cheap in comparison, but we can actually get it even cheaper than that by using a State Street fund with the name SPDR S&P 500 ETF. This has a ticker symbol of SPXL, and this has an ongoing charge of just 0.03%. This is one of the cheapest ETFs you'll ever find. Just one thing to note with the ticker symbols is that for each fund, they will have multiple ticker symbols. I've used the ones for the London Stock Exchange, but wherever you are in the world, I would just use the one that's most applicable to you. And another thing with this fund in particular is that there is another fund out there with a same ticker symbol, but it's actually a hedged version that's different to what this fund is. So just make sure you're looking at the right fund when you're using the ticker symbol. With both of these ETFs, you can't really go too wrong. Yes, you're betting on the US market, so you are taking a slight view there. And you're betting on the 500 largest companies in the US by market cap, but those largest companies in the US also happen to be the largest in the world, and they have global reach, so you still do have a lot of diversification there. And like we touched on with the global index funds, where you have a weighting of around 63% towards the US, all this is doing is just taking that 63 closer to 100%. Next up, emerging markets, and an area that I think probably doesn't get enough love and attention, especially compared to the big boys that we've already discussed, but definitely an area with such big potential that can't be ignored. The emerging market sector makes up only around 10% of the global market, but with such a large proportion of the world population, the potential there is huge. Of course, with higher potential does come higher volatility, so don't expect such a smooth ride as you might expect with the others. And these funds will also come with slightly higher fees. I've got two options again for you, one from Vanguard and one from BlackRock. The Vanguard fund is the FTSE Emerging Markets ETF with the ticker symbol VF EG has an ongoing charge of 0.22%. The second option is from BlackRock with the name iShares Core MSCI Emerging Markets ETF with the ticker symbol EMIM. And this has a slightly cheaper ongoing charge at at 0.18%. One thing just to be aware of when you're looking at these two funds is they do track different indexes, one from FTSE and one from MSCI, and there are slight differences in these indexes. The differences are mainly down to the countries that are included in each index and what each index provider classifies as either emerging nation or a developed market. For example, countries such as South Korea and Poland have been classified as an emerging nation by MSCI. But for FTSE, they've actually been promoted to a developed market and therefore not included in FTSE's Emerging Market Index Fund. You'll also see in the bottom right-hand corner that other countries such as China, Taiwan, and India also have slightly different percentages depending on whether you're MSCI or FTSE. In the grand scheme, this is not going to make a massive difference to your returns, but this is definitely something you need to be aware of, especially if there was a particular country that you wanted exposure from. When we compare emerging markets to developed markets in the last 10 years, developed markets have slightly outperformed the emerging markets, predominantly down to the technology sector, specifically the Magnificent Seven. We've all seen how quickly some of these top companies have grown, and that's dragged the development sector up, outperforming the emerging sector. But of course, this is not always guaranteed to continue. And I think over the next 5 to 10 years, the emerging markets is going to get a lot more popular. It's going to get a lot more headlines. And of course, we know the potential is there. I'm not saying that's necessarily going to happen, but it's just something I think is interesting to keep an eye on. And also just a note of caution that don't put too much emphasis on recency bias. Just because something has outperformed in the last 10 years doesn't mean it's going to do it in the next 10 years. Okay, moving on to the final two now. And these ones are slightly more niche and ones that you may not have considered. And these are a defense fund and a gold fund. And these are what I'd call more topical and situational. These funds are very dependent on world events, geopolitical, environmental, governmental changes. Due to recent conflicts, we've seen countries really start to increase their defense budgets. A lot of pressure is being put on increasing the capacity and the ability of their military. And this is a little bit exponential because if a country sees another country that maybe doesn't quite align with them increasing their military spend, then they're also going to increase theirs or put more pressure on to increase that defense budget. We've seen across Europe, especially the US, putting pressure on Europe to increase their defense budgets all across the continent. And with that, of course, comes an opportunity for those companies that are actually going to produce the hardware, the software that these governments are going to be buying. Now, I know this is not going to be an option for everyone, but I thought it was important to cover in case it was an area that you wanted to get exposure to. My choice if you wanted to go down the defense route would be the Future of Defense ETF by Han ETF. The ticker symbol for this fund is NATP. It's a very large fund by a well-respected provider. It has got a slightly more expensive ongoing charge at 0.49%. So you are paying for that slightly more niche nature, but it has a yearly performance of 58%. Now, of course, I'm not saying that's going to continue, but it's just to put that into context. Yes, you are paying a slightly higher fee, but the potential is similar to with the emerging markets, but this is even more potential. There's going to be a lot of volatility here, but the potential is huge with these types of funds. And if we continue to see increasing conflicts and increasing disagreements all around the world, this is only going to increase. The other fund I have for you is a gold fund, and this has actually been acting in a very similar way to the defense funds. And this could be an option if you wanted to get that exposure, but you don't want to go down investing into a defense company. You could invest into gold, which is a precious metal that's very defensive in nature. And what we tend to see is what we call a flight to safety. And this is where there's a changing geopolitical events, and there's just an increase in tension around the world. People tend to flock to gold for that safe haven property. You could, of course, go out and buy gold yourself, but that does come with a lot of complications, namely security, the sourcing, and of course the storage of it. By using a product such as the iShares Physical Gold ETC, this allows you to get exposure to the gold market, but without the complexities of that physical storage. This fund actually invests into physical gold when you buy into the fund, so it's backed by the exact thing that you're wanting to get exposure to. And it has an ongoing charge of 0.12%, so it's still relatively cheap. And finally, I wanted to show you the best way to find ETFs and what to look out for when you're choosing these investments. For this, I use the website Just ETF. And on here, you can search any ETF you can think of, whether you've got a couple in mind, so you can also compare two and you can compare the stats. Or if you're starting from a blank page, you can do what I'm going to show you now and start by filtering down where potentially you might want to invest into. So say, for example, we know that we want to invest into the American market and the S&P 500 because we know that's one of the most popular index funds. What we can do is to start to filter down all of the ETFs out there. So on here, you'll see on the left-hand side, you've got a list of different options from equities, bonds, precious metals, commodities, real estate, money markets. So most of the ETFs that you're going to invest into are going to be predominantly equity-based. So if you click on equity, you've then got a few different options. Now, we know that we want to invest into the United States market. So we're simply just going to come down to country and select United States. That's still going to bring up 307 ETFs. That's still too many for us really to scroll through. So we're also going to set another couple of filters. The main two that I'm going to be looking at is first, just the size of the fund. Now, you've only got two options here, larger than 100 or larger than 500. I would generally always go larger than 500 million. What that's going to do is ensure there's a good amount of liquidity in the fund and also make sure that it's got a good reputation behind it. You know, a lot of other people have invested into this, so it shows it's got that reputable nature that you're after. The other thing you can then do to filter this down even further is choose between accumulating or distributing, which, like we touched on earlier, is choosing whether you want the income paid out or whether you want that reinvested back into the fund. So just like we've done with all the others, I'm just going to choose accumulating because we want to focus on growth. We want that dividends reinvested to grow the fund as much as we can. So now we're down to 52. So that's not too bad to go through, but say you wanted to narrow that down even further. Say you knew there was a particular provider you wanted to invest into. You could just come down here and click on provider, and it's going to show you all of the providers that have these funds. But for this example, I'm not going to do that. I'm just going to look through the 52 that we've got. So once we've got our filtered results, we can now start to compare them. And say, for example, the most important thing to me was what it's going to cost. So I would then look to filter by TER. So this is going to filter them all by the ongoing charge for that fund. And you'll notice the second one down here, the SPDR S&P 500 fund, is the one that we actually chose earlier. And the main things that stand out for me here is that it's a considerable sized fund. It's got that low cost and it's got 503 holdings. So it's doing the entire S&P 500. If you compare that to the one above, also by State Street, which only invests into 207. So you want to make sure it's investing into the whole index, especially with the S&P 500. But if you were less concerned with the cost of the fund and you mainly just wanted the largest funds out there, well, then of course you would just sort by the fund size. And here, when we sort by fund size, you'll see the BlackRock fund here, iShares Core S&P 500, the Invesco, and the Vanguard are all at the top, the three largest funds. All very similar in cost, with the iShares and the Vanguard fund at 0.07 and the Invesco fund at 0.05. And then you can click into any of them to then explore more information. And I'm going to do a separate video on this because it deserves more time going through all of the different information on this website, but just to show you what it looks like. So here you can find the ticker symbol of VUAG. So if you were looking on a different website, you could type in that ticker, make sure you're looking at the right one. Obviously, you've got the inception date, the size of the fund, the replication method, whether the fund is physically buying those shares or whether it's doing it synthetically. You've got the cost, which we've discussed, and also the distribution policy. For this one, I've got accumulating. There's of course so many to choose from, and I've just picked a small handful of my favorite here today. But let me know if there's some favorite ones that you've got that I haven't mentioned today. Let me know down below in the comments. And if you want to find out how you can put together your own DIY portfolio, then check out this video here where I look through all of the Vanguard funds to try and put together my own global ETF portfolio that is cheaper than Vanguard's typical global ETF. Thanks for watching, guys, and I'll catch you in the next one.